Right, well, thank you, Rachel. And could I start by also thanking the ACCA in North America and Julie Missimore and Vincenza Piccolo in particular for organizing and hosting what I hope will be an illuminating and game-changing event. I'm going to kick this off by briefly talking about the joint initiative on accounting reform that Rachel mentioned, and its related call for action. You should find a link to the call for action in the chat. It's directed to CFOs and CROs and subject matter experts from the risk management and accounting domains who support the adoption of the next generation accounting method, risk accounting, that potentially enhances the quality and effectiveness of non-financial risk management information and ensures the secure transition from financial profit to corporate sustainability as the primary accounting measure of corporate performance. And note the reference to non-financial risk management information. Just to be clear, this workshop isn't about changing the way non-financial risks are managed. Rather, its focus is on how they are reported and accounted for. And we've one very simple aim for this workshop. We want you to join the call for action. But we recognize that will only happen if, after these 2 days, you are absolutely convinced that by adopting risk accounting, the constituencies we serve will have access to enhanced non-financial risk management information that will facilitate game-changing incisiveness and security in corporate decision-making. So let me give you a few examples why we believe accounting reform is necessary. I want you to imagine you've just inherited $50,000 and you're looking for ways to invest it. I show you this company, which has reported sustained growth in revenues and profits over a 7-year period. Your reaction is likely to be, wow, that looks really interesting. Then I suggest, before you get your checkbook out, you look at one more line. Here it is. Suddenly, it doesn't look quite so interesting. Out of curiosity, you ask, what is this NFR expected losses line? I explain it's the financial losses this company is likely to suffer in the future as a consequence of the non-financial risks that were accepted during its first 7 years of profit making. The types of risk could include cyber, climate change, supply chain, manufacturing, transaction processing, conduct, fraud, geopolitical, model, legal and compliance, and many others. So now let me ask a rhetorical and somewhat provocative question. When expressing their audit opinions on financial statements, independent reporting accountants typically state whether or not they present fairly or provide a true and fair view of a company's financial condition. If I remove the expected losses line, does this chart present fairly or provide a true and fair view if we disregard the probable future losses associated with the acceptance of non-financial risks? Given what we've been told about this company's risk profile, this chart looks worryingly incomplete. After all, if you're an investor, you'll have as much interest in what is likely to happen in the future as you would in what happened in the past. Admittedly, this is a fictitious company with fictitious numbers, but here's a similar analysis from the real world. In a laboratory test, we applied risk accounting to a monster data set made publicly available by the Federal Reserve Bank of Chicago that holds all the quarterly US GAAP financial statements, the so-called quarterly call reports, submitted by all regulated US bank holding companies going back to 1976. Our test was focused on the 2000s, as we wanted to analyze the period leading up to and including the global financial crisis of 2007-8. The test was applied to a sample of 15 of the largest US banks. The blue line in the lower part of the slide shows how net income before tax, or NIBT, experienced sustained subprime-fueled growth during the first 6 years of the decade, followed by the catastrophic crash in profits in 2007-8. The red line at the top of the slide shows accumulating exposures to non-financial risks computed through the application of risk accounting. When we express NIBT, we use natural currency, in this case, the US dollar. When we express inherent exposures to non-financial risk using the risk accounting method, we use a new standardized unit of measurement unique to the method we call a risk unit, or RU. The standout metric from this test was that exposure to inherent non-financial risks grew from 1.7 million RUs in 2001 to 3 million RUs in 2010, an increase of 76%. And just as an aside, there's a session tomorrow when I'll explain how we intend to assign a monetary value to RUs so we can value non-financial risk exposures. If you want to read up on this test, a peer-reviewed research paper that describes the test and results in great depth was published in the Journal of Risk Management in Financial Institutions. And I offer my thanks to my colleague Mahmoud Mazouk, who was my sidekick in writing this paper, and who I believe is on the call with us now. And you'll find a link to the paper in the chat box. Now, we can only speculate if boards and C-suite executives would have acted differently had this non-financial risk metric in RUs been available at the time. But I think we can assume that such a surge in exposures to non-financial risk would have demanded some form of response. Similarly, we can only speculate what accounting reforms would have been pursued if this metric in RUs had been proven at the time to be a reliable quantification and valid aggregation of accepted exposures to non-financial risk. However, what is clear in retrospect is that in the years leading up to the crisis, banks were reporting massive subprime-fueled profits while polluting the global financial system with toxic subprime waste, which in 2007-8 mutated into catastrophic losses that severely depleted the banking system's capitalization, threatening global economic meltdown. So the big question accountants need to ask themselves is, why do accounting standards tolerate the acceptance of material exposures to non-financial risks in one accounting period and the reporting of associated financial losses in a subsequent accounting period? This risk and profit-taking now losses later accounting has undermined the confidence investors and other stakeholders have in accounting profit. It also opens the door for less principled businesses and their employees to play fast and loose with investors, customers, the environment, public health and safety, and the well-being of communities. So, can this accounting anathema be fixed? To see if we can answer that question, let's take a closer look at what we learned from the global financial crisis. I'll start at the beginning by going back to 1999, when the Basel Committee on Banking Supervision issued a consultation paper titled A New Capital Adequacy Framework, which was the forerunner of Basel II, also known as the Second Capital Accord. In it, banks were challenged to devote the necessary resources to quantify their level of operational risks and to incorporate them into their assessment of their overall capital adequacy. The banks failed this challenge on 2 counts with devastating consequences. First, they were unable to come up with a meaningful way of quantifying and validly aggregating granular exposures to operational risk. In fact, what emerged was something called risk and control self-assessment that color codes exposures red, amber, and green rather than explicitly quantifying them. Second, the elite banks lobbied the Basel Committee to authorize the use of their in-house models to determine minimum regulatory operational risk capital requirements. The Basel Committee initially succumbed to the lobbying and formally adopted them in Basel II, only to reverse that decision about 10 years later when it announced their removal from the regulatory capital framework. And here's a quick recap of what happened. Banks' in-house operational risk models are collectively referred to as the Advanced Measurement Approach, or simply AMA. When adopting them in Basel II, the Basel Committee needed a guarantee they would provide an impregnable ring of protection against systemic risk, so it mandated they incorporate a safety parameter expressed as a 99.9% confidence interval over a one-year horizon, the so-called Basel Soundness Standard. Using admittedly simplistic shorthand, the Soundness Standard is intended to produce an amount of protective capital sufficient to buffer the largest loss that is likely to occur once in 1,000 years. Let me repeat that: to buffer the largest loss that is likely to occur once in 1,000 years. The fact is, within 5 years of the implementation of Basel II, we were in the midst of a global financial crisis. In 2007-8, banks around the world began to fail serially, triggering government bailouts, forced acquisitions, and even bankruptcies, the most well-known being that of Lehman Brothers. The AMA models and the Soundness Standard evidently failed to produce the intended effect. The 1,000-year ring of protection was breached within 5 years. Against this backdrop of failing banks, a three-stage emergency program coordinated by regulators and legislators around the world averted global economic meltdown. In stage one, taxpayers' funds were used to recapitalize the banking system. In stage two, regulatory and legislative straitjackets were applied to banks to contain their more extreme risk-taking, most notably through Basel III and in the USA, the Dodd-Frank Act. And in stage three, as already mentioned, the Basel Committee removed AMA models from the regulatory capital framework, which was announced in 2016 in the following terms. The AMA's inherent complexity and the lack of comparability arising from a wide range of internal modeling practices has exacerbated variability in risk-weighted asset calculations and eroded confidence in risk-weighted capital ratios. The committee is therefore proposing to remove the AMA from the regulatory framework. The bank's failure to come up with a method of quantifying and validly aggregating their operational risk exposures with any acceptable degree of precision effectively handed free rein to the regulators to impose whatever capital calculation method they believed would produce a regulatory capital buffer sufficiently large to mitigate systemic risk and guarantee the stability of the financial system. The result was a universally applicable standardized operational risk capital calculation method that uses proxies from financial statements and historic losses as indicators of the existence and likely scale of operational risk exposures in place of any form of explicit risk measurement. The method was contrived to produce oversized capital buffers that coerced banks into holding eye-watering levels of inert, unproductive and costly operational risk capital reserves, irrespective of the quality and effectiveness of their risk mitigation activities, processes and controls. So boards, CEOs and CFOs are left to navigate their organizations through a veritable minefield of ever-increasing exposures to complex non-financial risks with weak and ineffective management information, namely non-comparable and non-aggregatable color-coded risk and control self-assessments, quantitatively modeled estimates of operational risk exposures that have now been abandoned by the Basel Committee, and a regulatorily mandated standardized capital calculation method devoid of any form of explicit risk measurement. A 2017 report titled The Future of Operational Risk from McKinsey & Co. and ORX agrees with this rather unfavorable conclusion. The report summarized the responses to a survey of chief risk officers from 15 leading financial institutions in the following terms. Many still described existing operational risk management information as backward-looking, shallow, not dynamic, and hard to compare across the organization, when what they wanted was information that was regularly available, comprehensive, comparable, action-oriented, and forward-looking. The extreme subprime fueled losses reported by banks in 2007-8 predominantly fell into two categories: credit risk and market risk. However, the cause was weak and ineffective internal risk controls that failed to prevent the creation and distribution of toxic subprime financial instruments across the global financial system. Unquantified and unreported accumulating risk exposures invariably pass a tipping point when they mutate into realized financial losses. Said another way, any material unexpected financial loss must have previously existed as a material unquantified and unreported exposure to non-financial risk. Or to use more technical language, although I feel this is a statement of the blindingly obvious, accumulating non-financial risks and subsequent associated financial losses are positively correlated. But there's a difficulty here because there's no generally accepted method of quantifying and aggregating exposures to non-financial risk. Indeed, enterprise-wide non-financial risk management information is generally available in traffic light, red, amber, green form, which means that classic portfolio management techniques available to financial risks, including predictive modeling, aren't available to non-financial risks. So, what has the accounting profession contributed to the resolution of this non-financial risk conundrum that has tormented the banking sector and its regulator for more than 20 years? I'm afraid the answer is very little. Accountants would presumably argue in their defense that a non-financial risk is inherently unobservable. Only outcomes are observable, and you can't account for the unobservable. But this defense no longer cuts the mustard. The investor community and others have publicly announced their loss of confidence in the primary accounting measure on which investment decisions are based, which is financial profit, and are demanding it be replaced with a new measure, corporate sustainability. So, what do we mean by sustainability? There are probably many definitions out there, but the one adopted by the Joint Initiative on Accounting Reform has an accounting bias, and here it is. Sustainability is an organization's capacity to provide investors with reliably predictable returns on their investment in financial, environmental, and social terms. And note the emphasis on reliably predictable. After all, investors aren't gamblers. In other words, corporate sustainability in accounting terms is an organization's accounting profit or loss, which is the backward-looking or historic perspective, adjusted for the expected losses associated with accumulating non-financial risks, reduced by the positive offsetting effects of ESG attributes, which is the forward-looking or future perspective. And ESG attributes include the risk mitigating impacts of an organization's human capital, intellectual capital, environmental protection, and community well-being. So, in short, corporate sustainability is the blending of backward and forward-looking financial performance within a common accounting and reporting framework. The absence of accounting standards that address accumulating non-financial risks and offsetting ESG attributes has consequences. Most significantly, the default position of standard setters is to deal with these elements outside the financial statements in the form of narrative and/or statistical disclosures rather than accounting within the financial statements. A December 2020 Harvard Business Review article titled "The Future of ESG is Accounting?" describes the situation rather neatly. And it's worth noting that one of the authors is the Harvard and Oxford professor, Robert Eccles, who was the founding chairman of the Sustainability Accounting Standards Board, formed a little over 10 years ago. There are still no universally adopted standards for how companies can measure and report on their sustainability performance. Instead, we have a large number of NGOs working independently to develop standards for sustainability reporting, which is creating complexity and confusion for companies and investors. While most companies today issue sustainability reports, these are divorced from their financial reports, making it difficult to see the relationship between financial performance and sustainability performance. When the good professors talk about sustainability reports being divorced from financial reports, I believe they are making the same point I've already made. That is, when addressing ESG and sustainability reporting challenges, standard setters are focusing on disclosure outside the financial statements to the exclusion of accounting within the financial statements. If that is the case, the likely outcome will be a costly bureaucracy that fails to fully deliver corporate sustainability reporting with the consistency, comparability, and auditability demanded by investors and other stakeholders. So, how does our joint initiative on accounting reform and its call for action propose to address this conundrum? The proposition is that a new branch of accounting is called for that we're calling risk accounting. The Joint Initiative on Accounting Reform's mission is to conclude, based on empirical evidence, whether risk accounting provides a viable accounting-based foundation on which financial profit can securely transition to corporate sustainability as the primary accounting measure of corporate performance. So, what is risk accounting? It's a standardized and integrated non-financial risk management and accounting framework that identifies, quantifies, aggregates, values, and reports all forms of non-financial risk and accounts for the expected losses associated with accepted non-financial risks, including the positive offsetting impacts of ESG attributes. I won't go into a detailed exposition of the risk accounting method now, as most of tomorrow's workshop will be devoted to just that. But I will summarize its three primary features. First is the production of blended quantitative and qualitative non-financial risk analytics that are aggregated along the horizontal and vertical dimensions of the enterprise. Second is the codification of a standardized accounting framework that values, accounts for, and reports all forms of non-financial risk, net of offsetting ESG attributes. Third is the availability of an auditable foundation on which accountants can risk adjust accounting profit and shareholders' equity through accounting for expected losses. It's important to note that we are not claiming that risk accounting is a panacea for all sustainability and ESG reporting challenges. Rather, we see risk accounting as a line. On one side of the line are the sustainability and ESG reporting challenges that should rightly be addressed by accounting within the financial statements. And on the other side of the line are the sustainability and ESG attributes that are more appropriately addressed through disclosures made outside the financial statements. The good news is that a risk accounting model for application in the banking sector has been successfully codified and tested in academia. We now need to validate it through proofs of concept and other types of field testing and begin the work of adapting it for non-banks. However, we fully recognize that our mission can only be achieved by bringing together experts from both the accounting and risk domains across all industries, whether they be academics or practitioners. We also need the engagement of CFOs and CROs to sponsor this initiative and provide access to live operating environments to enable proofs of concept and other forms of field testing. So I'll close there by expressing the hope that by the end of the workshop, you'll be enthusiastically signing up to this groundbreaking journey into the new and exciting world of risk accounting. Thank you.